How banks work and create money. Have you ever wondered how banks make their money and declare billions in revenue? You try to imagine what the process is like. How can the little interest they make on transactions amount to so much? If you think banks rely on money from transaction charges, then you are in for a shocker. In this video, I'll be revealing the secret of how banks make money. Watch till the end because this video goes really deep down the rabbit hole. Banks produce most of the money in the economy through bank deposits. Your deposit is the amount that shows up in your account balance. Every time a bank grants a loan, new funds are created. 97% of the money in the economy today is in bank deposits. The remaining 3% is the actual cash with the Bank of England's emblem. Banks generate money by their method of offering loans. The balance in your account is simply an accounting record stored in the bank's computers. This figure represents an obligation or IOU owed by your bank. However, you can use their ATM card or online banking to spend these IOUs, just like real paper bills. Remember earlier, I revealed that banks generate new money with each new loan they make. This may be difficult to accept, but it's not a secret to those familiar with the banking system. Banks generate cash from the deposits of the loans they issue. When a bank offers a loan, say a mortgage loan for instance, it doesn't just hand over thousands of pounds in cash. Instead, it creates a deposit equal to the loan amount and credits their bank account. Boom, the bank has created new money. Banks generate revenue by crediting the accounts of their customers when they grant loans to those consumers. Martin Wolf, a longtime associate of the Independent Committee on Banking, was quoted by the Financial Times saying, "The essence of the modern financial system is the creation of funds from nothing by private banks' frequently stupid lending." Banks have grown the supply of money in circulation by an average of 11.5% yearly over the past 40 years using this method. Banks generate revenue in various ways, but essentially they are money lenders. They typically generate income by borrowing funds from depositors and paying them back at a predetermined interest rate. They loan these funds to borrowers who pay back at a higher interest rate. However, banks typically diversify their lines of business and make money through non-traditional financial services like wealth management and corporate banking. The money-generating activities of banks can be described according to the following categories: capital markets income, interest income, fee-based income. Banks frequently offer more capital market services to investors and enterprises. The financial markets are simply a marketplace where companies looking for funding for expansion or ventures connect with investors looking for a return on their investment. Banks support capital market activities with various services, including sales and trading, merger and acquisition advising, and underwriting. They use their internal brokerage services to assist in the execution of trades. In addition, they hire specialized investment banking teams from various industries to help with equity and debt underwriting. Essentially, they help businesses and other entities raise loans and equity. The corporate finance teams will also support corporate mergers and acquisitions, M&A. These services are offered in return for payments from customers. Income from the capital markets is a very unreliable source of revenue for banks. They rely more on the capital markets activities at any particular time, which may vary greatly. In general, activities will decrease during economic downturns and increase during boom times. Interest income is the main income source for most commercial banks. As was previously said, banks remove public deposits that do not currently require their money. The depositors receive a specific interest rate and insurance for their monies in exchange for making a deposit. The bank then lends the deposited money to borrowers who are in need of it. A greater interest rate than that given to depositors is required of the lenders to return the borrowed monies. The margin between interest received and interest paid, known as the rate of return spread, is how the banks make profit. Banks depend on interest rates as their main source of income. Central banks determine interest rates by regulating their level. This is in order to support a robust economy and manage inflation. Long-term forces on supply and demand also determine interest rates. Higher prices and lower rates of interest will result from greater demand for debt instruments with extended maturities. In contrast, limited demand for debt instruments with extended maturities will lead to a reduced price and increased interest rates. Banks gain from being capable of charging lenders a greater interest rate while giving customers a low interest rate. They must control credit risk, though, as borrowers could potentially stop making loan payments. And generally speaking, banks profit from an economy where loan rates are rising. This is because banks can secure fixed-term deposits that pay a lower lending rate while allowing them to make money by charging borrowers a better interest rate. Therefore, it seems that banks would suffer from a declining interest rate environment as fixed-term deposits are committed to paying a greater interest rate while interest rates offered to lenders are declining. Banks also impose non-interest fees for their services. For instance, the bank may impose monthly fees for maintaining an open account if an account holder opens one. In addition, banks collect fees for several additional services and goods they offer. Examples include credit card charges, savings accounts, escrow accounts, revenue from mutual funds, custodian fees, fees for investment management. Banks can make money from the fees charged for the wealth management services they frequently offer to their clients and from fees for particular investment products like mutual funds. Banks could provide internal mutual fund services for customers to invest in. Since they are constant with time and do not vary, fee-based sources of income are particularly appealing to banks. It is advantageous, particularly during economic downturns when interest rates can be unnaturally low and the activity on the financial markets may slow down. The question, how do banks make money, is deceptively straightforward. Of course, charging loan interest is how banks generate revenue. A common, ironic response to this query was the 3-6-3 rule, the rule that bankers should pay 3% interest on deposits, receive 6% annual interest rates on loans, and then leave for the golf course at 3 p.m. The 3-6-3 rule combines an element of reality with a greatly oversimplified perception of reality, like most excellent jokes. Undoubtedly, most banking organizations continue to derive most of their earnings from the interest margins that banks make from serving as a middleman between depositors and borrowers. However, charging fees to its clients in exchange for a range of financial services allows banks to generate large amounts of non-interest income. These financial products include standard banking services such as checking and cash management, safekeeping accounts, and safe deposit boxes, trust accounts and long-term certificates of deposit (CDs), and annuity contracts for investments and insurance. The widespread use of new financial procedures and pricing strategies is increasing the fee income of many banks in other conventional areas of banking, like consumer loans and retail payments. Additionally, banking organizations have recently benefited from deregulation by engaging in atypical industries like financial services, stockbroking, and insurance firms and underwriting, and fund manager sales to produce sizable amounts of non-interest income. Surprisingly, non-interest income now makes nearly half of the operating revenue the U.S. commercial bank generates. Banks perform more than just acting as middleman between both borrowers and depositors. The business has never been restricted to earning interest margins alone, and over time, it has gotten further away from that idealized portrayal of how banks make money out of thin air from debt. The most obvious sign is the striking rise in non-interest expenses at financial institutions, which by some measurements now accounts for close to half of the industry's income. Growth in non-interest expense for some banks came from new business ventures made available by the 1990s historic rollback of onerous financial rules. These ventures include investment banking, stockbroking, and insurance agencies. For other banks, an increment in non-accrual loans comes from new manufacturing processes greatly facilitated by advances in computer technology, communication systems, and financial processes. These processes produce traditional banking services like securitized bank loans and electronic payment services, and numerous banks have executed both. However, when issues occur based on the borrower's side and the bank cannot retrieve their money, it will be left to the bank to cater for the balance and repay the depositors. This could cause several problems to the bank, and it could end up in its own closure or folding. You can invest in this channel by clicking the like and the subscribe buttons. Thanks for watching.